Before we start this video, do like and subscribe to our channel and not miss on any updates.
We have been discussing that businesses function in a competitive environment and every business must understand who are its competition, what are the strengths of the competition, how strong are the competitors. All these things a business must analyze. Today may be possible there are 5 competitors in the market. After 1 month, 5 more competitors come into the market. Now this business has to deal with 10 competitors and not just 5 competitors. Maybe in the future a new product comes into the market which can replace our existing products. So this kind of scenarios are also possible, and competitive landscape is continuously changing. It is ever changing environment. Now, how do we understand this competitive landscape, or how do we understand what is the level of competition in the market? How do we understand what are those risks which a company is facing from the competitive landscape? So, Michael Porter gave a framework which is called a Porter's 5 forces model. Now, in this model, Porter talks about 5 different forces which impacts the competitive environment or which can be used to understand the competitive environment. Let us have an overview of the model and then we will talk about each of the forces in detail. At the center of the model is the competitive rivalry between the existing firms, meaning how are the existing firms competing with one another? Is there a cutthroat competition? Is there a severe competition, or there is very less degree of competition, or there is no competition at all? What is the level of competition in the existing industry or between the existing firms? So that is the center of the model. On one side, Porter tries to explain what is the threat of new entrant, meaning is there a risk that new competition would enter into the market or new businesses would enter into the market? What is the threat coming from a new entrant? Today maybe there are only 5 players in the market. Can 5 more players come into the market in the next 1 month time, or in next 6 months time, or in the next 1 year time? What is the possibility of new players coming into the market or new businesses starting business in the industry? So that is about threat of new entrants. On the other side, there is a threat coming from substitute products, meaning these products are very closely related to the product of our existing business, and the substitute products have the ability to satisfy the same demand of our customer. So you would have learned in economics that tea and coffee, they are considered to be substitute because some customers may buy tea or they may buy coffee. They are indifferent. They don't have any specific preference. They are happy with tea. In the same way, they are also happy with coffee. So these are the case of substitute. Are there any companies which offer substitute products? So if there are more companies who are offering substitute products, then our business might be in danger. So on one side you have threat of new entrants, on the other side you have threat from substitutes. And then Porter also realizes that the bargaining power of supplier and bargaining power of customer, these 2 forces also play a very important role in the competitive landscape. Now you may wonder, how does supplier affect a competition? We'll understand that when we go to the specific force. So quickly to recap, there is an existing rivalry in the industry. There is a threat of new entrant entering into the industry. There is a threat from substitutes. There is something called bargaining power of supplier and bargaining power of customer. Let us understand the first force, which is threat of new entrants. Now when we talk about threat of new entrants, what we are referring to is there a possibility that new companies or new businesses can come into the industry and they can start production of goods or supply of services which will take away our business? Now this aspect talks about how easy or difficult it is to start a new business in our industry. So maybe we are operating in a particular industry. Is it easy for someone new to come from outside? That's why the term used is new entrant. Is it easy for someone from outside to come into the industry, start the business and run the business, taking away our market share? That is what is talked about in the threat of new entrants. Let us take a couple of examples to understand what exactly do we mean by threat of new entrants. Say you are walking down the road and you saw a grocery shop. And at the grocery shop, there are lots of customers who are waiting to buy grocery from that particular shop. And that is the only shop in your area. A couple of houses next to that shop, there is a vacant shop which you can take on rent and start a business. This is one scenario. So there is a grocery shop, there is a lot of demand for grocery products. There is also a vacant shop which you can take on rent and start your business. This is one scenario. Come to the other scenario. As you are walking down the road, at some distance, you saw a car dealership. Now even in that car dealership, there is a huge rush of customers. That is the only car dealer in your area. There are a lot of customers who want to buy cars, and this also looks like a very good business. Now in both the scenario, what you saw was there is a huge demand, there is limited supply, and if you start any of these two businesses, you will be able to make a good amount of profit. That is what you thought. Now tell me one thing, which business do you think is easy to start? Now you are an outsider. Is it easy for you to enter into the grocery business, or is it easy for you to enter into the car business? Now when you compare these two industries, you will see that to start a grocery shop, maybe you will need some 10 lakh rupees. But if you want to start a car showroom, to buy just one car, it will cost you around 6 to 7 lakh rupees. So at the cost of one car, or at the cost of one unit of inventory here, you can actually run the entire shop if you start a grocery business. So capital required for the grocery shop is much lower as compared to the capital required for the car dealership. This is one aspect. The other aspect is, to run a grocery shop, some amount of common sense would be enough. But to run a car dealership, to run a service center for those cars, to understand the technicalities of the car business, you will need some experts. So manpower requirement is also very different. Maybe to open a grocery shop, you don't need permission from anyone. But to get a car dealership, the car manufacturer may not give you a permission. You may not be able to start the car dealership on your own. You will have to take the permission from car manufacturer. The car company may have a policy that in a 5-kilometer area, a new dealership cannot be started. Now, if that is the policy of the car company, do you think that you will be able to start a dealership of car there? It is not possible, because the company has a policy that a new player will not be allowed within 5 kilometers of area. So here if we see, to start a grocery shop is much easier as compared to starting a car dealership. Tomorrow if you think that I want to start a car manufacturing company, this is much more difficult than starting a car dealership, because to start a car manufacturing facility, you need a lot of land, you need thousands of crores of investment, you would need to set distribution channels. So many things would be required to start a car manufacturing company. But if you want to start a mobile manufacturing company, it is easier than starting a car manufacturing company. So when we talk about threat of new entrants, we must understand how easy or difficult it is for a new person or a new company to come into our industry and start the business. Now, because to start a grocery shop is very easy, this grocery shop is always at a threat of new entrant, because one fine day someone decides I'll open a grocery shop. Next to this grocery shop, a lot of business from this grocery shop will move to the new grocery shop. It is very easy. But because it is very difficult to start a car dealership, the car dealership will have some sense of security that in the 5 kilometers of area, no new dealership can come up, and this area is my area. So there is less threat of new entrant. There are various factors which decide whether it is easy to enter into a new business or difficult to enter into a new business. We will understand each of those factors. These factors are called barriers to entry. Now in the case of car dealership example, we saw that in 5 kilometer area you cannot start a new business. Now that is a barrier to entry. A new company cannot enter into this market because there is a barrier to entry. Some barriers to entry are low, some barriers to entry are high. It is like a wall around the industry. So some industries may have very low wall. So when the wall is low, it is easy to jump over the wall and enter into the industry. Some industries have very high walls or high barriers to entry. In that case, either it is impossible to enter into the industry, or it is very difficult or costly to enter into that particular industry. Now we will understand those factors which determine the barriers to entry. Whether there is a low barrier to entry, or there is a high barrier to entry, or there is no entry possible at all. So all these scenarios are possible. There are multiple factors which decide barriers to entry, which we will understand one by one. Now the crux of this threat of new entrants is, if it is easy for new companies to start business in your industry, your business is always at threat. On the other hand, if it is very difficult to start a new business in the given industry, the players in the existing industry, they are much safer. The first barrier to entry is capital requirements. Now, as we saw in our earlier example, the capital required to start a grocery shop is much lower as compared to start a car dealership. And hence, which one has a lower barrier to entry? the grocery shop or the grocery business has a lower barrier to entry. The car dealership has a higher barrier to entry. Now, if the capital requirements are high, the barrier of entry is also high. If the capital requirements are low, the barriers to entry are also low. Now, if the barriers to entry are low because of low capital requirement, new businesses can easily start in your segment, or new businesses can easily enter your industry. And if more and more businesses enter into your industry, what would happen? You will lose your existing customers, or you will lose your existing market share. Just imagine the case of that grocery shop owner. If today there is only one grocery shop and after 1 month there are 2 more grocery shops which open up, what will happen to the business of this existing grocery shop? A lot of customers would start moving to the newer grocery shops because this is already crowded. Maybe the new players are giving more discounts, so this can impact the business of the grocery shop owner. So whenever there is a high capital requirement to start a business, the barriers to entry are considered to be high, and new businesses or new firms cannot easily enter into the market. I am not saying that it is impossible to enter into this particular segment, but what I am saying is it is difficult to enter into the business because of the capital requirement. If the capital requirement is 10 lakhs, maybe 100 people can start that business. But if the capital requirement is 10 crores, maybe only 10 people have the money to start the business. So a higher capital requirement implies a higher barrier to entry. A lower capital requirement implies a lower barrier to entry. And we can see this if you look at many businesses which have come up in the recent time. How many new car companies have started manufacturing cars in India as compared to how many new mobile phone companies have started their business in India? Because to start a car company, there is a huge capital requirement. To start a mobile phone manufacturing company, the capital requirement is not very high. So you will see that more and more mobile phone manufacturers have come up in the market. But if you look at the car industry, very few players have started business in the last 10 years. The companies which manufacture cars in India today are mostly very old companies. Because to start a new company, if you and I think of starting a car company, we don't have the money. Banks will not give us finance. So because of the capital requirement being high, it is difficult to enter into this car industry. Now, what is the advantage to those existing companies? Because the capital requirement is high, Maruti can be sure that many new companies will not come into the market. And because of that, the competition, whatever is existing, only that will continue. Maybe 1 or 2 players in 5 to 10 years time might enter into the industry. But if you look at an industry which is the mobile phone industry, a lot of players enter every 2 to 3 months. So this makes the competition much more severe. Here, the existing players feel much safer because it's very difficult for new players to come into the market. The next barrier to entry is economies of scale. Now, whenever we refer to this term economies of scale, what we understand is as the volume increases or as the level of activity increases, the cost per unit starts falling. So coming back to our grocery shop example, you thought that to start a grocery shop is a good idea because you have the required capital with you. You took the other shop on rent, you purchased the inventory that is required, and you also started that particular shop. But what happened was, even after starting the shop, the rush that you saw at this grocery shop is not coming down. Means customers still want to go to this grocery shop and buy products. Though you are keeping the same kind of products, though you are keeping the same quality of products, very few customers came to you, but a large number of customers are still buying from this grocery shop. And one day you realize that this grocery shop is selling goods at 10% discount. Now you started wondering, how is this shopkeeper or how is this grocery shop owner able to sell those products at 10% discount? How is he able to give discounts to its customers? Later on, you found out that this grocery shop has 20 such shops across the town. It purchases the grocery in bulk. The shop owner has 20 shops and it buys in bulk from the suppliers directly. And because this grocery shop owner buys in bulk quantity, it gets a lot of volume discount. And you have only one shop, because of which you are not able to buy a huge volume of goods and you do not get the discount. Now you can see that this grocery shop owner has an advantage of economies of scale. And had you known this fact earlier, you would have thought of not starting the business because it would be very difficult for you to sell the goods at 10% discount and make profits. If you were aware of this fact earlier, you would not have thought of starting this particular business. So in industries where there are large players who have the advantage of economies of scale, who produce in huge quantity, who purchase in huge quantity, who sell in huge quantity, new players are generally reluctant to enter into such industries because there are already 2 or 3 large players who produce in bulk and who have the advantage of economies of scale. A new player may take some time to get the economies of scale and it might not be profitable to enter into such industries. So whenever industries have players or businesses who already enjoy a lot of economies of scale, new players would be less interested to enter into such industry because the existing players have advantage of cost. The new players will immediately not have advantage of cost unless they also enter into the market with huge capacity and huge volume of activity. Only in that case new players would be interested to enter, but otherwise new players would not be interested to enter into such industry where existing players have high level of activity or high volume of activity, giving them the advantage of economies of scale. For a new player to enter into such kind of industry, to have a very high level of activity or high volume of activity, they would need high capital, which again takes us back to the first barrier to entry that we discussed on capital requirement. So once the capital requirement becomes high, there will be fewer players who would be eligible to enter into this market. So if existing firms have economies of scale, a new competition would have to think twice before entering into such market. Otherwise, the new player would not be able to compete with the existing firms. So wherever you see economies of scale, wherever you see that existing player have low cost facilities, new players would find it difficult to enter into such market. So this is about economies of scale.